In my first year in real estate, my wife and I sold 79 homes and cleared $650,000 cash in the bank. Not revenue, not GCI, cash in the bank. There's an important distinction there, and it is the whole point of this video, because most agents who have a great first year have nothing to show for it. They did the deals, they collected the commissions, and then the money disappeared into expenses, lead costs, coaching fees, taxes, and lifestyle. So this video is not about what to do to get more deals. It's about how to actually think about the number you're trying to hit and make sure that when the year is over, the number actually ended up in your bank account. Here's the math that most agents never do. Let's start with a number, say $600,000. That is a real achievable target for a first-year agent if you run your business the right way. Like I said, we did it. If we did it, you can do it. But before you can build toward it, you need to know exactly what it takes to get there. And that means working backwards from the number instead of just hoping activity turns into income. Here is how to think about it. Take your income target and divide it by your average net commission per transaction. That gives you your transaction target for the year. For example, in our first year, we closed 79 homes and netted $650,000, which works out to roughly $8,200 net per transaction. So if your income target is $300,000 and your average net commission is $8,200, you need 36 transactions to get there. This is like second grade math. That is your number. That is what you are building toward. And when I say net, I'm not talking about GCI. I'm talking about your GCI minus your expenses, and all of your expenses, to be clear. Most agents never do this math. They just work as hard as they can, and they hope the number is good at the end of the year. The agents who actually hit a target do it because they knew the target in transaction terms, not just dollar terms, and they built their prospecting, their pipeline around that specific number. So let's talk about the difference between GCI and what you actually take home. This is where most new agents get blindsided. GCI, or gross commission income, is what you earn before anything comes out. What you actually take home is a completely different number, and that gap between those two is what determines whether you have a great year on paper or a great year in reality, meaning cash in the bank. The main things that eat the gap up are things like your brokerage split, your lead costs, your coaching investment, your transaction costs, your listing costs, and your taxes, of course. Every one of those is a decision you make, and some of them you can control more than others. In our first year, our split was 70% with a $21,000 cap at Keller Williams. We were spending roughly $3,000 a month on pay-per-click leads, and we had around $4,000 a month in other costs. We were a $755,000 GCI year. The net came out to about $650,000 before taxes. The difference was our expenses. The point is not to scare anyone away from investing in their business. Coaching costs money, leads cost money, splits cost money. All of that is real, and you should plan for it. The point is that you need to know those numbers going in so your income target accounts for them, rather than discovering at tax time that your $400,000 GCI year actually netted you $180,000. Quick pause before we go further. If you want the full buyer and seller systems behind what made our numbers work, it's all in our Insider Systems course. This exact framework we have was developed from over 1,600 transactions. It's all in one place for you to tap into. Click the link in the description below. It's only $47 right now. Go check it out. But let's get back to the math. Now, how to structure your business so more of your GCI becomes take-home money. Once you know your target and you understand your expense structure, the next question is how to build the business so that ratio improves over time, meaning more of what you actually earn stays with you. The single biggest lever here is lead source ROI. Not all lead sources cost the same amount per closed transaction, and the difference between a high-cost lead source and a low-cost one compounds significantly over a full year of volume. We went all in on PPC leads, pay-per-click, from day one because the long-term cost per acquisition worked in our favor once we had developed the conversion skills to work them properly. We close about 1% of these leads in the first 90 days and another 2 to 3% over the following couple of years, including leads we have closed 5 years after they first came in. It can be a long conversion cycle. The single biggest lever here is the lead source ROI though. We also got a lender to chip in and co-market with us, which helped cover the cost of PPC. The second lever is when you make your first hire. A transaction coordinator who charges $300 to $400 per file, paid only at closing, costs you absolutely nothing until you get paid, and immediately buys back hours you would have otherwise spent on paperwork. That time goes back into prospecting, which feeds the pipeline, which produces more closings. Making that hire earlier than feels comfortable almost always comes back to pay for itself faster than agents expect. Let's talk about the mindset difference between agents who hit the number and the agents who miss. Here's the thing that does not show up on any spreadsheet. The agents who net $600,000 in their first year are not necessarily working harder than the agents who net $150,000 a year. They're making different decisions. And most of those decisions happen the first 90 days before there's any evidence that they're going to pay off. They hire a coach before they've made any money. They invest in a lead source before they know it's going to work. They block their mornings for prospecting even when there's nothing in their pipeline yet. They sign buyer agreements and they run buyer consultations before either of those things was required or common. Every one of those decisions feels premature at the time. It's super obvious in hindsight. The version of you that net $600,000 in year one makes those calls early and they commit all into them. The version that looks back on a disappointing first year almost always waited too long on every single one of them. If you want the step-by-step breakdown of exactly how to structure your first 30 days to build the pipeline that makes these numbers possible, I have a video on this channel that goes through it day by day. That video is linked below. Go watch it next.